thought that the credit quality story was really interesting because
good or bad?
Not good.
Okay.
Well, only in the sense that on one hand, when you see these charge-offs start to rise or credit quality start to weaken a little bit, on one hand, yes, it does signal some weaknesses in the consumer, but it also shows you that the banks are willing to lend into that weakness. So, for example, Citigroup said that their net charge-off rate will be between 3.5 and 4%. We're already heading into levels above pre-pandemic. And JP Morgan said that theirs will be below 3.5%, which is less than Citigroup's. But again, they're looking to increase net interest income once again. And that $90 billion projection that they gave for this full year implies 6 rate cuts this year. So if you see less, there is a chance that JP Morgan makes more money next year than it did this year in net interest income.
Does the credit quality issue, Sonali, have you concerned about the economy?
It has me very curious about what the next week looks like with regional banks and credit cards. So fun fact, last year, Capital One stock rose more than 40%, while Bank of America's rose less than 2%. And so people have loved these credit card businesses. But we're heading into a point in the economy where delinquencies are starting to rise, and they're rising above those levels from pre-pandemic. So, and honestly, buy now, pay later loans, they're not calculated in your FICO score. So there are a lot of questions about the consumer right now.
All right, let's bring in Anton Schutz, who has been following the bank sector, I should say, for a long time. Anton, and we love reaching out to you. What's your net on the results we got today? And you join us, of course, on Zoom in Florida.
Yeah, well, I think it was really a mixed bag. I mean, the stocks had really ripped into these numbers. Fourth quarter was a pretty large, powerful move. A lot of it was driven by short covering because bank failures did not continue. The credit disaster hasn't happened. Commercial real estate is not good, but it isn't destroying the banks. So, I think the Fed, pivoting has really been a big factor. Clearly, people have picked on their securities books because, they bought a lot of long-term bonds, helped fund our giant deficit, and they got paid back by having terrible marks on those books. But at the end of the day, that's no longer a story. People aren't focusing on that this minute. And I think these numbers were just good enough. No major move in the index today. I mean, you had Citibank up because, people are looking at the future, even though the numbers weren't great today. JP Morgan's numbers were probably the best and their guidance is probably the best. But, Bank of America, which may have had the worst numbers, full disclosure, we own it in our fund, is barely down. So at the end of the day, I think these numbers are just basically, the porridge is the right temperature. And now it's, what's the Fed going to do? People are going to continue to look at credit quality. And as Sonali basically talked about, as we look at the regional banks, we will see some more real estate exposure. We will see some of the bigger ones potentially show some worsening there. Consumer, clearly subprime is an issue. So the difference between Citibank and JP Morgan's credit card portfolio
Anton,
clearly shows in what they're doing.
I'm really curious about what you think about what fair value is. On one hand, Bank of America, you saw a small tick downward in their stock today. They're trading barely at book value. Wells Fargo took a more than 3% hit on the day, and they were trading well above book value. Do you think that book value is all these banks are worth?
No. I mean, I think they just have to prove. I mean, look, we've had a very large move already, but yeah, I think the move is just sort of begun as long as the Fed continues to play nuts, because the Fed cutting rates will also help credit quality, right? You talked about credit quality. Yes, it's a little worse. Obviously, they've all built reserves. In fact, Bank of America actually released some reserves. So, building reserves is all about getting in front of credit losses, and I think it's what they see or what they expect. So I expect these companies to trade at higher multiples. They do have to prove it by getting a higher return on equity. And none of them, had spectacular returns on equity this quarter. However, if you back out the special charges, to really replenish the FDIC fund for funding some of the failures, the numbers are better than they look on a return on equity perspective.
Hey, let's talk net interest income. Sonali mentioned it, but the bank said that this year, or last year, I should say, I'm still writing 2023 on my checks, Carol, was the peak after the net interest income haul of $253 billion. We got a chart up for our YouTube audience right now that shows just how big this was in comparison to the last 10 years. What do you think? I mean, do you think that there's a chance that if rates do indeed stay higher, we could see 2024 look like a solid year for net interest income?
We certainly could if rates stay higher, but I think if rates stay higher, I think we have worse credit quality. So, careful what you wish for. I do think that gradual moves down rather than violent moves will be helpful for everybody. Helpful for the banks, help them adjust their cost of funds, maybe not have NIM get crushed, net interest margin get crushed as much, and certainly will help on credit quality. As people have loans they've got to refinance, and again, I think the mistake that a lot of the shorts made here was that they assumed that every commercial real estate loan is going to reprice immediately, and whereas there's a 5 to 10 year period of time these reprice. So the lower rates go, the better credit quality is, and we don't have that as something to talk about, and we'll give up a little bit of NIM. I think at the end of the day, these banks are not going to have a lot of loan growth, and because of that, they're building a lot of capital. So once we have clarity on the playing field, the regulators have not made it entirely clear on how much capital they need to carry. I think the return of capital, dividends and buybacks, could be a very big story for the biggest banks, especially if loan growth is not much to talk about.